Hi, in this video, we are going to start working on the numbers of Hindalco that are available with us, and we're going to try and do a little bit of financial statement analysis around this. Let's take points one by one. We're going to start with the broader understanding of the P&L, and we're going to look at what's happening to the company in terms of data that is immediately available to us, right? So we look at the fact that sales has been kind of growing, albeit at a very steady rate. Last 3 years, sales has been kind of steady. The company has also seen costs growing up dramatically, specifically in the year 2015, where there is a big jump in the costs, and consequently the operating profits have been kind of steady around 7,900 to 8,000 number. It has jumped very recently in the last year or so. So that seems to be an interesting and good performance by the firm. Then there are some other data points which say that the company was okay in terms of profitability till here. Then for the last 3 or 4 years, it has seen declining profitability. Though in the last year, there was still a good sort of jump that the company has kind of been able to witness. Right? If we broadly look at the vertical analysis of the firm, and we try and look at the cost structure and the margins of the firm, we do see that operating profit margins for the firm has gone up. This is EBITDA margin, earnings before interest, tax, depreciation, and amortization, right? If we want to look at EBIT, then EBIT would come somewhere here. We can calculate the EBIT if we want. Net margin of the company has been anywhere between 0 to about 4%. So it's not a very high profitability kind of a business that exists at this point of time, right? The next bit we look at is the same analysis on the balance sheet. And when we look at the balance sheet and we look at all the data points on the balance sheet, a couple of things will be interesting and important for us. One of which would be the fact that the balance sheet size obviously is expected to go up because balance sheets are additive in nature. But if we look at the debt number seems to be phenomenally large post 2013. It's more than 50,000 crore almost all of the years. And if we combine the long-term and short-term debt, that works to about 65,000 crore in most of the years, right? There are some other financial liabilities. This is a term that has recently been introduced in the accounting standards, and what this basically a lot of the time includes is the current portion of the long-term borrowings. So let's say I borrow a 5-year loan, but that is due in 2018 somewhere or 2017 July, right? Now that this year in 2017 statements would get classified as a short-term loan, but it is technically not a short-term loan. So what we do is, let's say I take a 10,000 crore kind of a loan, and that's supposed to be kind of repaid in 2017 July. That's a short-term liability. That'll come here as other financial liabilities, also known as the current portion of long-term maturities. A lot of the times you will find this. So if you have to look at the long-term debt, that has to be a sum of this and this usually, right? So that's the first understanding we have about the company. We will also look at the fact that there are certain intangible assets that the firm has, which are about a third of their tangible assets when you look at it. Just broadly looking at the numbers, you'll find intangible assets are there. Now, this is a metals and manufacturing kind of a company. So intangibles don't make too much sense unless, of course, these intangibles are some form of goodwill. So that gives us a sense that probably there is a goodwill angle to this. We know goodwill would come when a company acquires another firm and overpays for that firm. So basically you are acquiring a firm, and when you're acquiring a firm which is worth X, but you're paying X plus Y, then that Y is going to be the goodwill, right? So that goodwill amount seems to be here. We'll check that further, whether it's exactly goodwill or something else. We'll look at that as well as we go along. We do look at a fair bit of inventories with the firm. We do look at fair bit of receivables with the firm. Uh, in terms of payables, payables are also large, given that it's a large company. We do find those numbers a fair bit. If you look at the vertical analysis once again, you will note that in terms of data, what the firm shows more. Let's look at the asset side. We would see that out of the total assets, fixed assets or non-current assets basically hold nearly close to 65%. What does that tell me? Probably it's a capital intensive industry. A lot of capital is required to kind of keep running this from time to time. That's also evident from the fact that your loans are high. So there is a high debt incidence. And so looks like a high capital intensive kind of an industry. We will also probably get the same data point if we look at the P&L ones. And if we were to look at the data points here, you would find that out of your 12% operating margin, a large chunk of it directly goes in the form of effectively your EBITDA, your interest and depreciation. Again, pointing to the fact that there is a large capital intensity. Both of these high components. So your EBITDA is about 12 rupees on 100 rupees, but your net margin is about 1 rupee or 2 rupees. And that's because about 9 to 10 rupees in between is going out of the EBITDA only in the context of either depreciation or interest components. So that's the second portion that we have in terms of our understanding looking at data. It is capital intensive. It has a higher debt component that plays out. And there are obviously components which will be there in terms of short-term term loans, etc., which will play out. Inventory is about 12%. It has been fairly consistent over the last few years. You could actually check trends and see what's happening there. So over a period, tangible assets have increased, and over a period, the debt number has actually remained steady, right? It's the equity number which probably has kind of increased over these years, and consequently, the debt number has kind of stayed steady uh, over this time frame as we look at it, right? Then we move on to the cash flow, and we just have three line items in the cash flow. And what we would realize looking at these three line items is that your cash from operating activities has almost always been positive, which is good news for the firm. However, your total cash flow has never been a significantly positive number. And that's because of primarily one reason is the fact that the company seems to have done a lot of investment activities here. So capacity expansion seems to have happened in these years. And how are they funding this huge capacity expansion? It seems the company has taken a lot of loans. So this period is the period where the company has borrowed money and it has done an expansion, right? After this, these 2 years, it seems the company has been repaying the loans. And there is a reasonably good operating activity that is available here. Cash from operating activity that is available, it's increased in the last year, obviously because profitability has increased. But they seem to be repaying some of the debt here, which is typically an indication of good performance that the firm has been able to kind of generate in the last couple of years, courtesy which they probably have gotten down their debt incidence a little bit, right? So that's basically around the cash flow. Just by looking at these 2 or 3 line items, you could gauge whether the company is funding its expansion. So what you see is the fact that expansion funded by debt and now repayment of debt happening. Those are the two observations we get out of this. Operating profitability, with the exception of 2013, seems fine, right? So that looks broadly okay. And 2013, incidentally, was the year where, if we look at the data points, their profit was fine, right? So their profit margins were absolutely fine. But then the numbers kind of changed a little bit in terms of what their overall metrics in terms of cash from operating activities was during that particular year. And now, if we want to kind of identify where is that coming from, we are seeing that while this year was fairly profitable, their operating cash flow has gone down a lot, right? 2013 was equally profitable as compared to some of the other years. So they made 3,000 crore of profits. If you add the depreciation to this, automatically that goes to 6,000 crore, but the cash has gone down, which basically means that in 2013, working capital changes resulted in this negative operating activities, resulted in negative impact on CFO, cash flow from operating activities, correct? Now, what are these working capital changes? You will note that specifically there are primarily three headers which would be we would have to check. So inventories actually went down. Current assets going down should be net positive. Receivables marginal reduction again should be net positive. What's causing this negative trend is the fact that your trade payables probably went down dramatically, and that caused overall current liabilities to go down dramatically. That's again reverted back to the mean kind of number over the next couple of years. So it seems 2013 trade payables, this was probably an anomaly which caused some sort of a trigger in terms of the cash flows going down in this particular year. We can dig deeper to try and understand, but because the payables went up again next year, it automatically kind of went back to historical trajectory in terms of cash from operating activities. That's broadly it in terms of our overall understanding on what seems to be happening. We do need to check if the final couple of years is purely repayment of debt, or is purely interest payment that is happening overall. So we will look at that. It doesn't seem debt has gone down dramatically in the balance sheet. So for all practical purposes, what seems to be happening is probably a lot of interest payment coming in, right? If you look at the long-term debt, which is here, and add short-term debt, total debt is about 71,000 crore. And if I add these three, that's about 69,000 crore. So yeah, about 2,000 crore of debt it seems has been repaid at this point of time, looking at these numbers, right? So that's broadly what we can infer directly looking at these data points from the statements that we have. That's it in this particular video. In the next video, we're going to start calculating these ratios given the formula here, and we're going to work around that calculation as we go along. Thank you.